All right. Good afternoon, everyone. Welcome to today's session. We're going to go over another strategy. We're going to talk about the poor man's covered call. Excited to talk about this one. Last time we did a strategy, it went over really well and you guys wanted more of that. So we wanted to make sure that we do this. Some of this is related and there's a lot of good information there. I am going to talk about the Greeks a little bit. We covered that in an extensive session a few weeks ago. I'm going to explain it along the way so you don't have to go through that hour session just to understand it. But a lot of it's really important when we talk about the poor man's covered call. So really excited to dive into this one now. All right. And a important disclaimer, as per usual, types of securities forms and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Getting a couple of comments in the chat saying that my audio settings might be off. Can you guys hear me okay? Can you just hit yes in the chat? Oh, good. Perfect. Thank you. I appreciate that. All right. So here's what we're going to cover today. We're going to review a covered call because a poor man's covered call is a type of synthetic option. So it just requires less capital. We'll go through the benefits, what it's utilized for. I'm going to actually switch it up today and use OptionsPlay's platform and actually go through how to find a trade, place a trade, how to analyze it and compare it with a traditional covered call. I did it based on a security that I personally do. So I'm probably going to end up placing the trade too. So I think it's just an interesting view on how to properly implement the strategy. So we'll do that today and see how that goes. So please feel free to ask questions along the way when we go through that. So we're going to review the covered call first, just so we have a good refresher on that. I'll show you how to build the poor man's covered call, what you're looking for when you're through that ideation phase. And then we'll go through strategy comparisons. So the benefits and the risks involved with the covered call versus the poor man's covered call. And then we'll go into practical application. That's where I'm going to actually pull up the OptionsPlay platform and go through all the tools and resources that are available to you for this strategy specifically. And then we'll put it all together and of course, save some time for Q&A. So I don't have an extensively long presentation today because I want to spend more time on the platform. So we'll see how that goes. So I appreciate you going with me through this journey. And yes, Mark, it is a type of a diagonal. We'll talk about that in a little bit. So starting with what a covered call is. This is probably a slide that you've seen before, but a covered call is essentially it's a short option position. You start with owning 100 shares of an optional stock or ETF. So you have to own a round lot. If you own at least a round lot of those, then you could sell a call against it. When you sell that call, you utilize the stock and exchange traded funds as collateral. So remember that a short call contains the obligation to sell securities at a specific price. And when individually, the short call is actually a neutral to bearish position. If you were to look at the profit and loss chart, it's actually completely flipped from what you see on the screen. This profit and loss chart means that the upper quadrant here is profit. As you move down, this is loss. And as you move across, this is the strike price, or excuse me, the underlying security moving upwards. So that's what I mean when it's flipped. You would want the stock to not go higher than your strike price, which is true here. But as the stock moves up, you actually lose and you have unlimited loss potential. Whereas if you create a covered call by adding those optional stocks or ETFs as collateral, so you've got a price where you have purchased those securities at, now we have a predefined exit price with the covered call. That's the intention of it. Instead of having unlimited loss potential as the stock goes up, you just cap your upwards potential of the underlying security that you own. So those 100 shares of stocks or ETFs. And then the goal of that is while you're selling that call, you reduce the cost basis of those underlying shares. And that's how it can profit in a neutral to a bullish market. But the strategy as a whole, and this is inclusive of the poor man's covered call, is neutral to bullish. So know that if you're going to implement this strategy, you are bullish on an underlying security of some sort. So that's the important part that I want you to take away from this. So you own 100 shares of the ETF. That allows you to, or of a security, you sell a call option against it, utilize those shares as collateral. That creates an obligation to sell the stock or ETF. You have that obligation in exchange for a premium. That's the covered call. So that's important to know before we move on to the poor man's covered call, because we're actually going to go into a multi-leg option strategy, but I'll break it down for you. So as long as you understand a covered call, go ahead and type 1 for me in the chat window. Lots of ones. A ton of ones. I appreciate that. Perfect. All right. So building the poor man's covered call. Here's what we're going to look at. And this is where I'm talking about the Greeks again. And we'll do a comparison with some real examples as well, just to really drive that home. But when I'm building a poor man's covered call, all I'm doing is I am replacing the 100 shares of stock with a deep in the money call. So I want to call, and remember when we talked about the Greeks last time or a few weeks ago, when we talked about delta, a stock a call as it gets deeper into the money. So your strike price is lower and lower relative to the market, it gets a higher delta. So that means delta will be closer to 1. And when it gets closer to 1, the theta value, it actually is removed. Time value is depleted, and the option starts acting more like the stock. So what we're doing is we're taking advantage of that. And there are some anomalies there. When the option gets closer to that 1 delta, it gets very illiquid and it's difficult to trade because it's run its course. So that's not why we're not choosing a super, super high delta. And we'll talk about that. But what we're trying to do is replace the 100 shares of stock with a deep in the money call with a delta of about 0.6 to 0.7. So it's not all the way to that 0.9 delta. So it gives us some room for some upward potential is what that means. And the reason why we choose something 0.6 to 0.7 is because we want a little bit higher gamma, because remember, gamma means that it's going to move the security more. And so we want that because we want upward potential, and gamma is good for long options. And if we're bullish on something, that's what we want. So we're focusing a lot of this on the long in the money call as far as the way I'm looking at the Greeks. So I want a 0.6 to 0.7 delta, which means that it's pretty deep in the money. So that's how I'm going to choose my strike price. I want to make sure I've got a pretty decent gamma, and you could look at that relative to in the money. And I can show you how to do that even. And we're going to go through a lot of real examples. But then that's how you establish your long position to replace the stock, because now you've got a underlying security that's going to act as collateral for that short out of the money option, but it's going to act more like the stock, and you're not going to purchase too much time because it's super deep in the money. And those are expensive when they do that. The short out of the money call, that's something that you're going to do just like you normally would a covered call. So the same recommendations that we offer, or tools and best practices, and the covered call reports, those are all the same factors. So the 0.15 to the 0.2 delta, that's the short out of the money call. So the way that we would, and that's how you offset the extrinsic value. And I know I put on here shorter term and longer term, and I see a lot of questions kind of coming in about that. The long deep in the money call is going to be about 2 to 3 months longer than the expiration that you choose for your short out of the money call. So that's where it's kind of like, it's almost a hybrid between a bull call spread and a diagonal spread. So when you have your diagonal, you're not going to do something this deep in the money. Your strike prices are going to be, if not the same, really, really close. But when you do a bull call spread, you're looking more for upward momentum rather than that calendar premium. So it's a combination of that. We are selling short dated options a little more frequently, and we may have to adjust both of these often. So it requires a little bit more management, and we'll go through that as well. Do not worry. But that's the difference there. So we are focusing on upward momentum we're bullish on the security because we need that to happen for this long, deep in the money call. We want, just like the covered call, we need the underlying security to go to our higher strike price. So just keep that profit and loss diagram in your head. And then you just sell shorter dated options like you would on the security. This is just purely your stock replacement. Think of it that way. So in order to build it, when you're looking for something, it's important that you have something that's really liquid, because those deep in the money calls begin to naturally become illiquid, even if it's an extremely liquid security like SPY or Apple or things like that. That is absolutely going to happen. So therefore, you want something that is liquid so you don't have the risk of not being able to exit the position or roll this if you need to. So utilizing the liquidity ranking that's in the OptionsPlay tool is going to be really helpful for that. But you can also view open interest in volume and just make sure you see something there that you're looking for. And I'll show you how to do a little bit of calculations as well. You will want a lower IV percentile. So we show IV percentile on our reports and all over the platform. You want a lower IV percentile for this strategy together because you're buying it. And this is a really, really great point. Remember when we talked about the Greeks, and I keep referring to that so often, but I'm going to explain it along the way. Vega is how the option will respond to a 1% point change in implied volatility. And Vega is actually higher for longer dated options. So what that means is if you have a strategy that's positive Vega, it's going to benefit from an increase in implied volatility. So not that it's already happened, but if it does happen, then it's going to make the premiums go up in value, which means your option is going to go up in value, which is good for a long option. So since the primary driver of this strategy is this long, deep in the money call, we're looking for a positive Vega situation to help us get a higher premium on that long call that we purchased, because we want that upward momentum. And so we want a lower IV percentile, which means it's lower in comparison to its implied volatility. And that's something that we'd want to buy. So maybe looking for something under 50. And that's important to note because when we talk about covered calls purely, and we're not taking into account that there is a long option, it's kind of flipped. You would want something that has higher IV percentile because you'd like that to decay, and that's something you want to capture. But your primary factor in the poor man's covered call is the long option, not the short. And that's important to note. You are upside biased. So we said that earlier. You are bullish when you have the long poor man's covered call, and you have a positive net delta, which means that you're just going to benefit from upward momentum. And I'm going to talk about that in a lot more detail, but this is the high level building the poor man's covered call. What you need to know is you need a very liquid stock or ETF. You want a lower IV percentile, and that is going to have its characteristics if you build it with a 0.6 to 0.7 delta. It's a couple months later than your short out of the money call will automatically give you a positive Vega and a positive net delta. So that's important to note there. Okay. And normally I pause and wait for questions at the end, but I want to go through these just real quickly and see if there's anything that stands out that I need to explain.
Hey everyone, I hope you've been enjoying the session so far. I would love for you to join me for the next live education event where you can learn alongside thousands of traders, and I'll answer your questions. Click the link on your screen or check out the link in the description below. For our OptionsPlay members, I host weekly trading education sessions just like this one, and you'll get to trade alongside our research team's daily trading signals, weekly technical research, and gain access to our options strategies analytics platform. Sign up for a trial and try us out for free for 30 days. We're here to help you succeed, and please make sure you like this video and hit the subscribe button. Thanks everyone, and let's get back to it.
Stock liquid with options as well would not necessarily matter. You want the options to be liquid, and sometimes they're illiquid in comparison to the stock, but they can be related. So normally an illiquid underlying security probably does not have liquid options. So as long as there's liquidity within the options, that is extremely important. And there is an important question here that I do want to answer. What is your goal for the covered call versus the poor man's covered call? And we'll go through that in a lot more detail, but that is something you should know up front. The covered call, you're right, is for premium generation. But you need to remember, when you have a covered call, you also own an underlying security. So in addition to additional yield, you do want that stock to go up. You don't want it to remain neutral. You would like that upward potential. And that's why we choose deltas that are 0.15 or 0.12 or 0.20, because that's going to give you a higher probability of expiring worthless and a higher strike price, allowing for upward momentum. So you still want upward momentum, and you still want the strike price that you choose at the top level to expire worthless. So they're similar in that instance. You are collecting premium with the short out of the money call, and you are giving up a little more upward momentum. And we'll go through that in a moment, because you have the long in the money call. You don't have a delta of 1, because remember, a delta of 1 means 100 shares. So 100 shares of ABC Apple is a delta of 1. We're not doing that with the deep in the money call. We're having a higher delta, a 0.6 to a 0.7, but that's not exactly like the shares. Therefore, there's less upward momentum. But yes, that is abstract. You are right. And we are going to go into real examples and real securities right now. And I pulled these this morning, and due to the market volatility today, the security actually stayed the same. And I was very happy about that. I was afraid I'd have to change these around. But what I did is I pulled a security based on the covered call report. And we'll go through that as well. I've got the OptionsPlay platform up and everything ready to go through that. But I searched the covered call report. I'll show you exactly where that is. And I found something I sorted it by IV rank. Let me just show you how I did that now, actually. I think that might be a good idea. So here on the OptionsPlay platform, here is, so if you're on the platform, you click this button here, it'll take you to the OptionsPlay hub. And then in the OptionsPlay hub, I am going to the covered call report here, which I've preloaded over here. And what I did is I sorted it by implied volatility rank, because remember I said you want a lower implied volatility rank, which just under 50 is what I'm looking for in order to execute upon this strategy. So these are optimal covered calls that have been pre-screened for you. This is the way I got my idea generation. I've found GIS on here, so I'm just going to Command F it, find it. So this one here is what I chose. And then you click that and it'll preload it into the platform. So that's what we're analyzing today. A lower implied volatility rank. This gave me a recommended strike price. So normally you're doing a covered call, you'd utilize this if you own the shares or maybe even purchase the shares. So let's compare that if you were to purchase the shares now or do the poor man's covered call now. And we'll go through the benefits, the risks, and why it would be executed and so on and so forth. Go back to this one. So comparing strategies, this is GIS at 70.75, which is, make sure it's still around that right now, which it closed at 70.75. So that works out very well. So we have the long stock. If you bought 100 shares at 70.75, it has a delta of 1. That's what this number is right here. We do the short call. This is the same one that was showing on that report. You'd sell one GIS June 17th, 75 call at a premium of 60 cents. And that had a delta of 0.2. The poor man's covered call, this is a little bit of a higher delta. I needed to change that to 0.75. I changed this a little earlier. I apologize. That should say 0.75. But we have a 62.5 call at 980. And we use the same short call with a delta of 0.2. So here's the differences right away that you see. This requires $7,000 worth of capital. This requires $920 worth of capital. So there's the difference there. Some of the risks with the poor man's covered call, as you noticed, is I love to show those profit and loss diagrams. It's very difficult to do that with the poor man's covered call. And so we look at it with purely this expiration, not this one. So therefore you can't actually accurately calculate a break-even point because of the implied volatility factor, and that these expiration dates do not match. But we're looking at it by just the June 17th date because this is a replacement for our underlying security. So we're looking at it purely from that perspective. So from that perspective, we want both of these strategies. We want GIS to go to the strike price. So we want it to go up to $75, about $4.25. Both of those are true within this scenario. Therefore, this is a neutral to bullish strategy. This is neutral to bullish because we still collect that 20 cents. Bullish is going to help us out a lot more, but the goal is if the security was to remain below our strike or right to it or something of that nature, you could close it out just like we show you on our best practices for covered calls when you reach those profit points and then roll it out to a higher or a lower strike, just depending on where you feel the security is going to go. And I'll show you how to look at that as well. Your max risk is identical. It's the cost of the strategy. You can only lose as much as you spent. And that is why it's called the poor man's covered call. We've created a very similar profit and loss risk profile by purchasing this deep in the money call. So that's why it is. It's called the poor man's covered call because you are spending less capital and you are purchasing a deep in the money call as a replacement for the underlying securities. So your goal is the same in both scenarios. That's why it's bullish. We would like the underlying security GIS to go to 75. We spent 7,015 over here. If that reaches our max profit potential, we'll make 485. Over here, we'll make a little bit less, 330. And that's where I want to go back to the deltas that I was talking about. A higher delta means that it's a delta of 1, means that as the stock moves up $1, you will make $1. This has a delta of 0.8. This one, since it's 0.75, be 0.65. So that's going to be a little bit less. So there's less upward momentum, and that's okay. Because if you look at this from a risk reward perspective, we're risking 7,015 to make 485, but we're risking 920 to make 330. And so from a percentage perspective, this one can be a little more rewarding, but this is a little bit more risky because the underlying security, the stock does not have an expiration date. This one does. So theoretically, we could hold this one forever, and this requires less management, but this one requires a lot more management. Yes. And so I chose this June 17th based on that report. I probably wouldn't have chose something out to October 21st. However, it was the only thing that was available besides the next one, the way that these contracts were on their cycle. But what I'm looking for is something that is that higher delta, which means it has less extrinsic value priced into it, which you can see here, the difference of those two numbers of 70, 75 and 62.5 is really close to 980. So that extrinsic value component is minimal. So it's a little bit more expensive because of that, but that's how it starts acting like the stock. This is longer dated. And so that's an interesting component, but that's how you utilize it as a stock replacement strategy. All right. Okay, let's move on. I do see a lot of questions on. Some of those are going to be answered. There is one here. Can you review the calculation for the goal? Yes. So this is only assuming June 17th. Otherwise, that calculation changes. This is more of a dynamic calculation. So normally this one is done at expiration. This is done at expiration for June 17th. So it's the difference of the strikes. And this is the difference of 70, 75, and 75 less what you paid for the strategy. So both of them are the same calculation, different outcomes. So the difference of these two, so your upward momentum is your max gain possible, just like a bull call spread. That's where it's like a bull call spread. And then it's less the amount that you paid for it, which is the same calculation that you would utilize for a bull call spread. And you are right. If the stock did not move, it's possible you can lose more because you have extrinsic value. associated with it. And that's why it's important to manage this. But you can, if the stock does not move, this will deplete in value. You could close it, and then perhaps you'd move this strike up a little higher. Or if it's completely sideways, you'd keep this and then sell another call against it. So that's the goal of it. So yes, there are risks associated with this, and there's more risks than a covered call, but there's less capital. So that's the variation there. That's important to note. Max loss is equivalent in both of these cases to what you paid for. So max loss for the poor man's covered call is 920, and this one is 7,015, because the stock could theoretically go to zero. This one's going to expire though, so again, requires more trade management. All right, let's move on. And then a lot of what I just said is actually outlined in this next slide here. So a covered call versus a poor man's covered call, this is that risk reward that we want to look at, and the calculations are here as well. So your sentiment is neutral to bullish. This is a little more bullish biased, and so is the covered call. There is substantial risk because it's the cost of those shares that are reduced by the premium received for the covered call. There is substantial risk for the poor man's covered call, but it's less. It's the cost of the long call reduced by the premium received by that same short call. Your profit potential is capped in both instances. And something important to note is when you own an underlying security, you have voting rights, you're entitled to the dividend, and your stock is not going to expire. You have a poor man's covered call, you do not own the stock, therefore you don't have any rights for voting. You aren't entitled to any dividends, and it requires more trade management. And more importantly, it's going to require margin because it's a spread. So it's something that your broker isn't going to allow you to put on unless it's done in a margin account. All right, so that was the educational piece that I wanted to cover. And I'm going to switch it over to the OptionsPlay platform and just go over a couple of tools and resources in looking at this and really the process involved. So again, we were looking for a low implied volatility rank, which is here. Earnings is something to be wary of, but you can also look at implied volatility relative to the chain. And then once we do that, I plopped it in here, and I actually plotted the covered call, 100 shares, and the poor man's covered call right here. Now this profit and loss, that's why this kind of falls off because of the expiration of June 17th. So that, like I said, it makes it a little wonky. However, I think it's a good comparison, and that's what I like the tool OptionsPlay. It really helps me compare different strategies and how I feel about that underlying security. So what I've done here is we've got GIS, General Mills. Let me log back in, give me 1 second. And we didn't click it fast enough. I hope those setups are still there. If not, that's fine. We'll do it real quick. And it is great. And then it flipped away. That's fine. All right, we'll rebuild it. So GIS is here. I'm looking for something with bullish potential. So that's number one. That this chart here makes it easy on you. I didn't plot these. These are automatic here. I added a couple of other indicators and things like that. However, nonetheless, OptionsPlay does the work for you and does some smart text to actually indicate that this is perhaps a buying opportunity. So it's moved out of this point of consolidation. Now it's in another point of consolidation. And that is an indication that this perhaps is a good buying opportunity because this is its next point of resistance. So therefore, if we are having a bullish bias, there's a lot of indicators that are giving us a bullish indication. So that's step number one. That's important, is I've chosen an underlying security from that report list, or however you have. You just need to make sure that you validate that you're bullish on that underlying security. That's a very important component. And then there's the little trends and things that do that as well. The liquidity says it's very liquid. It has a lower IV rank. So this is something that is optimal for a poor man's covered call. If it was a regular covered call, you'd want a higher IV rank and you would look for other factors. So know that that's different. So for a poor man's covered call, this is exactly what I'm looking for. So as far as the comparison, let me go ahead and modify this one. But if I wanted to view it, so I believe it was a June 17th, 75. And I need to make this a stock and flip this to sell. And we're going to buy it at, let's use the midpoint. That works. All right, so this is our covered call setup. And let me modify this one to give you the poor man's covered call. So we're going with the October. I believe I went for the 62.5. And you can see the delta there and the standard deviation, which is helpful for choosing strikes for the poor man's covered call. We're going to buy this one. We're going to sell this one. Let's make sure it's on the mid. Okay. So now we've got a comparison of buying the shares, capping the upwards potential with the covered call, and then doing a synthetic type of strategy with the poor man's covered call. So this is a good way to compare if this is something that you want to do or not. I think it's really great to bring in the plain English. This is something where I was at my other firm and we utilize this tool. This is a good learning factor to explain what's happening with the strategy. But what you can see here is what we were talking about earlier is your limited risk. So how much you're going to risk when placing this trade, your profit potential. So the purpose of a covered call is capping your profit potential. So this is limited, and the reward should be taking into account the upward momentum. And it tells you where your strategy will profit and then the probability of this happening. So there is going to be a lower probability with the poor man's covered call. And that's because you're going to have a lower delta. And that makes perfect sense. And then you can add the profit and loss simulator, and then we can go and understand exactly what happens when it goes to each price. And this is where, again, when we look at this, we want to look at the expiration, or sorry, the June expiration. So therefore, that's going to make a little bit of a difference. I noticed that this says July. I'm sure you guys put that in the chat window and I didn't catch it. I apologize. All right. There we go. So I think this is a valuable tool just to explain the differences of it. So your possible return with the covered call, your possible return with the poor man's covered call. All right. And I think the best tool with this, and it's utilizing, first of all, that covered call report, because you're going to utilize the same short options as that covered call report. You're going to take that covered call report and click on the underlying security and validate your bullish sentiment utilizing these tools here. Or whatever is at your broker, you can use an analyst recommendation or something like that. Anything that's going to validate that you are bullish on that security, that's extremely important. And then this technical analysis helps determine the price targets. If I know that this is going to stop right at this price level, that's a great strike price to choose because I'm capping upwards potential. And so that's kind of utilizing the same processes that you would for a covered call. And the difference that makes it a poor man's covered call is simply because you are purchasing a deep in the money call with a very high delta. So it's going to act like the security. You're going to give up a little bit of upward momentum. However, you're going to retain the same risk reward profile, profit loss diagram. And that is important to be a similar strategy. All right, so that covers what I wanted to cover today. I know we ended a little bit early there, but we'll save the next 10 or 15 minutes for questions if you guys have any. And we can certainly talk about other things, but anything around this options strategy that you guys want to talk about, please feel free to put a question in the chat or in the Q&A window. And there are a lot that are in here. Oh, David, thank you for watching me on CNBC earlier. That was nice. I had 30 minutes to prepare for that one, so that was fun. All right. What would be the best timing to close the long call? So you really want liquidity within that option. And that's something that I would be extremely concerned with when I have a deep in the money call. So when you have a deep in the money call and you have some extrinsic value there, I would want to care for that. So you're going to adjust this as the stock moves up. Your goal is to retain that 0.6 and 0.7 delta. And so as the stock moves up, your delta is going to go higher. So therefore, when you're close to expiration or you meet the max profit potential of your short call, if the security is going up, you should be closing the strategy and creating a new one, moving everything up. So that long call should go up and your short call should go up. And that may not happen exactly at the same time. If it doesn't move up as much, or maybe it's a little sideways, that's a different picture, but you want it to move up so you can maintain those net deltas. That's the important part. So timing isn't necessarily a time frame, I would say. I would use a combination of technical analysis, but also maintaining those net deltas because I want that exposure and I want to remain bullish on the security is also an important part. What about rolling the sell call if the price of the security falls down? Yeah, you can roll down, absolutely. And you could roll your short call and that would give you a little more premium if you could get a credit for it. You could also roll the long call as well down, but remember, if the security is going down, it may not be, you may be wrong about your initial sentiment. So therefore you just have to retain bullish. As long as you're still bullish on the security, then I absolutely would just continue to roll it. But if I wasn't, then you may have to reassess the situation. Using for leaps greater than a year. Okay. That's something I've seen done before. And a lot of educators also teach utilizing them with leaps. But if you have a leap, you are kind of stuck on that strike price, and they are even more so illiquid. However, you could do a calculation to make sure that you have that right sweet delta spot, but I would probably even want a higher delta if it's a leap. So that's something to be careful for. So that's the time frame that's involved with it. So if you have the poor man's covered call, that's why we're looking for a couple months later. So you're probably going to have a 5 months option and a 2 to 3 months option. That if you have something greater than 5 months, you're stuck on a strike price, and that security is going to move above or below it unless it's neutral. And this isn't a neutral strategy; it's a bullish strategy. So that's why those shorter time frames are optimal for the poor man covered calls. But you can certainly do that if you feel that there is a strong level there, then that's absolutely fine. All right. Assume that well before the long call expires, the price makes the target and the short call is exercised. How do you use the long call in this case? So we do not want to hold this short call until expiration because we don't have a long position offsetting it. You ideally want the underlying security to go to exactly where your top strike price is or that higher strike price. However, we do not want to hold this until expiration. So once we're at a certain percentage of profit, I would go ahead and close that and roll out a higher one. And so just capitalize on that gain that I would have already made before it starts getting higher above that strike price. And then I have a higher risk of assignment at expiration. I wouldn't even want to, want to play that game, if you will, where it's close to my strike price on expiration. Therefore, I would roll in that. So I would not even try to hold that until expiration. That's something I would avoid at all times. If that does happen, like I said, it's a margin account that's required. You'll end up shorting a security, and then you can buy a long one to offset it. It would not make sense to exercise your long option unless extrinsic value is completely depleted, which is possible if it did go up above your strike price and you were subsequently assigned. Because even though it's a longer dated option, time value gets removed the deeper in the money that it is. And you can see that on an option chain. And the best delta to not get your shares taken away is the smaller delta. So that's why we say selling the call at a 0.15, so a 15 to a 20 delta. That is optimal because that means you've got a 15 to 20% probability of expiring worthless. And that is what we want, is we want we want a probability of it, a higher probability of it expiring worthless. And I definitely inverse that. You have a 15 to 20% probability of it expiring in the money. So therefore you've got an 85 to an 80% chance of it expiring out of the money, which is what we want. So we want it to expire worthless. Lower delta, higher probability of expiring worthless. Ratio of the debit paid to the width of the strike spread. So that's like risk reward. I would compare that to the rules applied for a bull call spread. So you want upward momentum. So that ratio is really determined on those net deltas. That's why I wanted to make sure before we had strategy specific conversations or educational content that we talked about the Greeks, because that's extremely important for strike selection. I'm not necessarily going to look at the width of the strikes. I'm going to look at the net deltas to determine my optimal strategy selection. The poor man's covered call in the strategy list, you can build it on a diagonal. You'll just have to adjust the expirations. What indicators do I have on my chart? I love the Ichimoku cloud and RSI. I also add MACD and a couple of moving averages. I have a whole different charting platform over here as well. But yeah, I think Rick, who just joined, he loves the Ichimoku cloud, and there's some really great educational content out there, but it's just a great indication of support and resistance. And it's something that just seems so consistent. I learned it maybe about 9 years ago. And it's pretty easy actually just to read. So this is the cloud. If you go above the cloud, so the candle here, if it goes above the test the cloud, so that's an indication of possible upward momentum. As the candle moves above, then now its resistance is new support. So we're looking for it to stay above the cloud. And as it stays above the cloud, you see here that it tested it. So that's an indication of a possible downward turn. Now that it went into the cloud, we're looking for it to either move back up to indicate upward momentum. So that's going to be our bullish indicator. But if it moves down like it did here, then that is an indication of a bearish trend. And then when it moves above it, so it just acts as support and resistance. And that's one of my favorite indicators to utilize in trading, period. Right. There was a question about the implied volatility webinar. Yes, we are going to do that. We pushed it out 2 weeks. Wanted to be a little detailed in it. I don't know why there's a double cloud. Great question, Alex. All right. Can you do the same thing with puts for bearish expectations? There is a poor man's covered put, but that's still a bullish security. Suppose you could, with a synthetic short, it is possible. You can make synthetics with options. So you could technically build things, but that would take a lot of thinking through. All right. And then showing how to get to the sheet to pick the security. Let me show you how to do that again. And your goal is not for it to go through your higher strike. You want it to reach your higher strike. You want the premium, so it's bullish, so you collect upward value on the long call, just like you would the long stock. And once it reaches your short strike, you want to get rid of that because it's shorter dated and it wouldn't necessarily make sense for you to exercise the long option or the long offsetting position that you have. So you really want to roll it out and adjust from there. You really want to avoid assignment at all costs with this one. You would only want to exercise a long call if extrinsic value is completely depleted. Otherwise, just go by the shares on the market. All right, so how to get to that report one more time. I've got a lot of my controls at the top, so I apologize. I'm gonna just move this one around. So on the platform, you're gonna click this button here, which is the education and resources. So right here, that is going to take you to the OptionsPlay Hub. On the OptionsPlay Hub, if you scroll down, there is a slew of educational resources, but this is where you'll find the opportunity reports is what we call them. So you access now, it may ask you to sign in again. And then once you access now, it will take you to this report. And the short put report looks exactly like this. So if you can sort it by days to expiration, by annualized return, by distance to strike, so your upwards momentum, if there's earnings coming up, if there's a stock price, so the lower the stock price, the lower that the capital is going to be required, raw return. So there's a lot of things here, but for the poor man's covered call, what's important is the implied volatility rank, sorting by that, and then you can choose from there. Once you click on a symbol, I'm just going to click this one. I think somebody said that earlier. It'll pull it right into the platform, that short call based on a covered call, and then you can modify it to a poor man's covered call. And that's how I would assess it. And this one had a great upward momentum. So someone who said that earlier, this would be a great opportunity because it looks like it's a good buying opportunity. It's got those bullish signals, bullish trends. Maybe I'd want this to go a little higher, but relatively close. All right, so we hit 5:02. I do love Bollinger Bands. We'll do technical analysis at some point. I think that would be something really great to do. We've got a lot of things that are there, but that'll conclude today's session. I really appreciate everyone joining and coming to these presentations. We're going to shift a little more towards strategies and maybe do some advanced stuff. I did do some different things with this, so love your suggestions. If you just want to send an email to info@optionsplay.com or click the link within the tool to send an email to our customer service team, those do go right to me and we amend based on that. So your feedback is very crucial and I really appreciate that. You guys are great. Thank you. I hope you have a wonderful day, a wonderful week. We'll talk to you soon. Thank you.